Your credit score might be the most expensive number in America, not because you see it every day, but because it quietly decides how much you pay for almost everything: your apartment, your car, your mortgage, even your insurance. And the difference between a 430 score and an 824 score can cost or save you hundreds of thousands of dollars. This is what life looks like at every credit score, from 300 all the way to 850. Imagine two people walking into the same bank on the same day. They both earn similar incomes. They both want the same car. They both want the same house. They both have similar jobs. But one walks out with a low monthly payment, while the other walks out paying hundreds more every month. The difference isn't luck. It isn't intelligence. It isn't even income. It's a 3-digit number most people barely think about until it's too late. And that number follows you everywhere. It follows you when you're trying to rent your first apartment. It follows you when you're applying for your first credit card. It follows you when you're buying a car, financing furniture, getting insurance, or trying to buy a home. Most people think a credit score is just a banking number. In reality, it's more like a financial reputation. The higher it goes, the cheaper life becomes. The lower it falls, the more expensive everything gets. Let's start where millions of Americans find themselves without realizing how much it's costing them: a credit score below 500. At this level, every financial decision feels harder than it should. You apply for a basic credit card and receive a rejection letter. You try another lender, reject it again. Eventually, you stop expecting approval and start hoping for a chance. When lenders see a score in this range, they don't see your story. They don't see why the score dropped. They don't know whether it was a medical emergency, a lost job, a divorce, or simply a lack of experience with credit. All they see is risk, and risk has a price. Let's say you need a car because your current one finally died. You walk into a dealership looking for reliable transportation, maybe a used sedan worth $15,000. The lender approves you, but at a rate that feels impossible. Suddenly, that $15,000 car becomes a $25,000 obligation. You're paying thousands of dollars in interest before you've even finished paying for the vehicle itself. Every monthly payment feels like a reminder that bad credit is expensive. Then comes housing. You find an apartment online. The photos look great. The rent fits your budget. You submit an application and wait. A day later, you get an email saying they've chosen another applicant. Sometimes they don't even explain why. Other times they ask for a larger security deposit, a cosigner, or months of rent up front. The apartment didn't get more expensive. Your credit score made it more expensive. Then insurance enters the picture. In many states, insurers use credit-based insurance scores to help determine premiums. Two drivers with identical records can end up paying very different prices. One pays standard rates. The other pays significantly more, simply because their credit profile suggests greater financial risk. The pattern keeps repeating. Higher deposits, higher rates, fewer approvals, more restrictions. It's like paying a penalty every month for mistakes that may have happened years ago. But then something changes. You decide to fight back, not with a miracle, not with a secret trick, just with consistency. You open a secured credit card. The limit isn't impressive. Maybe $200, maybe $300. But for the first time, you're building instead of repairing. Every month, you use the card responsibly. Gas, groceries, small purchases. Then you pay it off in full before the due date. 1 month becomes 3. 3 months becomes 6. Slowly, your credit file starts telling a different story. Lenders still aren't impressed yet, but they're paying attention. Your score climbs into the 500s. It doesn't feel life-changing at first. You're still paying high rates. You're still getting denied sometimes. But something important is happening. The direction has changed. Instead of sinking deeper, you're moving upward. That's when many people discover the most frustrating truth about credit building. Progress feels slow in the beginning. You can do everything right for months and see only small improvements. It feels unfair. But credit isn't designed to reward one good decision. It's designed to reward repeated good decisions over time. The system wants proof that the new version of you is permanent. So you keep going. 12 months pass, then 18. The late payments become older. The collections lose influence. The positive history grows longer. Eventually, you cross a line that changes everything, a score around 620. This is where doors begin to open. Not all the way, but enough to notice the difference. Credit card companies stop treating you like a high-risk applicant. Instead of secured cards, you're offered unsecured cards. Instead of paying deposits, you're receiving actual credit limits. Maybe $500, maybe $1,000, maybe more. For the first time, lenders trust you with their money, and trust changes everything, because once lenders trust you more, they charge you less. That's where the real power of a credit score begins. It's not about approval, it's about price. Most people focus on getting approved. Wealthy people focus on what approval costs. A loan isn't just a yes or no decision, it's a pricing decision. And every point on your credit score influences that price. The difference between a high-interest loan and a low-interest loan can quietly drain tens of thousands of dollars from your future without you noticing. That's why some people spend their lives working hard but never seem to get ahead. A portion of every paycheck is constantly diverted toward higher borrowing costs. They earn money. Interest takes money. They earn more money. Interest takes more money. The cycle repeats. But as your score rises, the cycle starts reversing. Now interest works less against you. Soon it may even start working in your favor. Because the real transformation begins when your credit score reaches the level where lenders actually compete for your business instead of simply deciding whether to approve you. And that's where the next chapter begins. When your score climbs above 680 and money starts behaving very differently. As your score climbs above 680, something interesting starts happening. The conversation changes. Before, you were asking lenders for permission. Now lenders start asking for your business. The difference sounds small, but financially it's massive. For years you were focused on getting approved. Now you're focused on getting the best deal. That's when credit starts feeling less like a burden and more like a tool. Imagine your score reaches 700. Nothing dramatic happens overnight. You don't wake up richer. You don't suddenly receive a luxury car or a bigger paycheck. But the financial system begins treating you differently. The same credit card company that once rejected your application now sends pre-approved offers directly to your mailbox. The same banks that considered you risky now advertise their lowest rates to you. Suddenly, you're seeing rewards cards with cashback, travel points, sign-up bonuses, and higher limits. The funny thing is that these benefits aren't reserved for the wealthiest Americans. They're often reserved for people who simply proved they could manage debt consistently over time. That's why two people earning the same salary can have completely different financial lives. One pays interest, the other earns rewards. One pays penalties, the other receives perks. The income may be identical, but the financial system treats them as if they live in different worlds. Let's look at a car loan. A few years ago, you might have financed a vehicle at a double-digit interest rate. Every payment felt heavy. Now, with a score above 700, lenders offer significantly lower rates. The monthly payment drops. The total interest drops. Thousands of dollars that would have gone to the lender stay in your pocket instead. That's money you can invest, save, or spend on things that actually improve your life. The same thing happens with mortgages. Most Americans will never make a larger financial purchase than a home. And because mortgages last decades, even a small difference in interest rates can create an enormous difference in total cost. Imagine saving just $200 per month because of a better interest rate. That doesn't sound life-changing, but over 30 years, that adds up to more than $70,000. $70,000 because of a number most people only check a few times a year. That's why credit scores aren't really about borrowing. They're about opportunity. The higher your score climbs, the more options become available. And options have value. When you only qualify for one loan, the lender sets the rules. When 5 lenders want your business, you set the rules. You compare rates. You negotiate. You walk away from bad offers. The power shifts. Around this stage, another benefit starts appearing. Lower credit utilization becomes easier. Your limits increase. Maybe one card goes from $1,000 to $3,000. Another increases from $2,000 to $5,000. You haven't changed your spending habits, but your available credit grows. As a result, your utilization ratio falls automatically. That lower utilization helps your score rise even further. It's a cycle working in your favor for the first time. Many people never realize that the financial system often becomes easier as you become more trustworthy. The hardest stage isn't maintaining good credit. The hardest stage is building it. Once you've established a long history of responsible behavior, the system starts rewarding you more consistently. Then you reach the mid-700s. This is where lenders often classify you as a preferred borrower. That word matters. Preferred means you're no longer paying extra because of perceived risk. You're receiving the rates that advertisements actually promote. You're getting the terms that many applicants hope for but never receive. Your mortgage rates improve again. Your auto loan rates improve again. Your insurance premiums may decrease. Premium credit cards become available. Larger credit limits become normal. At this point, the gap between you and someone with poor credit becomes astonishing. Years ago, you might have paid over $10,000 in interest on a modest used vehicle. Now you might pay only a fraction of that amount on a newer, more expensive car. Same roads, same destination, completely different cost. That's the hidden power of credit. Most people focus on what they buy. Few people focus on what financing costs. Yet, financing often determines whether an asset becomes affordable or expensive. Then comes a level few people ever reach, a score above 800. At this stage, your credit report tells a simple story: long history, low utilization, no serious delinquencies, consistent payments, years of proven reliability. Lenders see stability, they see predictability, they see very little risk, and because they see very little risk, they offer their best terms. But here's the surprising truth. The difference between a 760 score and an 830 score is much smaller than the difference between a 560 score and a 630 score. The biggest gains happen during the climb. Once you're already considered an excellent borrower, there are fewer additional benefits available. That's why chasing perfection isn't necessary. Reaching a strong score matters far more than reaching a perfect score. Many people obsess over getting an 850. In reality, very few lenders care whether you're 800 or 850. Both are exceptional. Both qualify for outstanding terms. Both unlock the vast majority of available benefits. The real battle isn't between 800 and 850. It's between poor credit and good credit. That's where the biggest financial consequences exist, and this is where many people misunderstand credit entirely. They think a credit score measures wealth. It doesn't. Some wealthy people have mediocre scores. Some people with modest incomes have excellent scores. A credit score measures one thing: how reliably you've handled borrowed money in the past. That's all. Yet, because that information predicts future behavior, lenders use it to make decisions worth hundreds of thousands of dollars. Over time, those decisions shape entire financial lives. Think about two 25-year-olds. One ignores credit completely, misses payments, maxes out cards, opens accounts carelessly. The other pays every bill on time, keeps balances low, and treats credit like a long-term asset. 5 years later, the difference is noticeable. 10 years later, it's significant. 20 years later, it can be life-changing. Not because one person worked harder, not because one person was smarter, but because one person paid less for money over a very long period of time. That's the hidden story behind credit scores. They're not just numbers on a report, they're multipliers. Good credit multiplies opportunities, bad credit multiplies costs, and those effects compound year after year. The most important part is that credit improvement rarely requires perfection. It requires consistency. One on-time payment won't transform your future. 100 on-time payments might. Keeping balances low for 1 month won't change much. Keeping balances low for years absolutely will. Time matters, patience matters, consistency matters, because every month becomes part of the story your credit report tells, and eventually that story determines whether money works for you or against you. From 300 to 850, the distance looks enormous, but every great credit score started exactly the same way, with a single on-time payment followed by another and another, until years later the system had no choice but to trust them. And in the financial world, trust is often worth more than money itself. If you found this breakdown useful, take 30 seconds today and check your own credit score. Because whether your score is 430, 630, or 830, the next 50 points could save you thousands of dollars over the next few years. And remember, nobody builds excellent credit overnight. It's built one payment, 1 month, and one good decision at a time. If you enjoyed this video, hit the like button, subscribe to the channel, and turn on notifications so you don't miss our next deep dive into money, credit, and the financial systems that affect your everyday life. Thanks for watching, and I'll see you in the next one.